What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 26th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to do something a little bit different. I want to have a one-on-one conversation and share my long-term positive perspective on cryptocurrencies. As many of you might have seen over the last couple of videos, I've been sharing my short-term bearishness or my concern that we've got a little bit further down to go before we really can call an end to this bear market. But at the same time, I want to focus on a really positive outlook in the long run. I believe crypto is here to stay. It's going to become growingly relevant over the coming decades. And there's a really interesting 10 to 20% case scenario that could really send Bitcoin and many other cryptocurrencies into the stratosphere here in the time where people least expect it. So without further ado, let's go ahead and kick things off. And if you enjoyed this video, guys, consider dropping a like. Let's go ahead and kick things off. Now, as I mentioned earlier, you guys know that in the near term, I'm talking over the next couple weeks, next couple months, we expect crypto to continue pulling back and entering into a consolidation or capitulation phase. Essentially, we have more further downside, and we need an extended period of time where Bitcoin and other cryptocurrencies can push sideways, essentially showcasing that the trend is ready to reverse to the upside. But irrespective of when that is going to happen, I want to focus on the long-term potential value thesis for investing in Bitcoin. Now, of course, there will definitely be room for Ethereum and other altcoins in this potential scenario, and I do want to talk about that later, but I want to go ahead and focus on why Bitcoin could really have its moment to shine over the coming decade. And it has to do with pulling great inspiration from the last major wave of inflation that we had back in the 70s, and the commodity we're pulling inspiration from is none other than the time-tested store of value asset, and that is gold. Now, I know a lot of you are thinking, Nick, come on, stay focused on crypto. Why are you talking about gold? I'm not even a major gold bug, guys. You guys know we don't talk about gold and silver too much on the channel due to its really lackluster performance over this past decade, and that's an important point to talk about here within this thesis. But as you all probably know, if you've done some research on the history of gold, you probably know that one of its greatest periods of growth came back during the 1970s when we had our decade of inflation, where the Federal Reserve and other central banks across the world were losing control on the currency and the cost of goods and services, and mainly in the trust of the traditional financial system. With the breach and basic dismantling of the Bretton Woods system, the removal of the gold standard, and of course record deficit spending for funding things like the war in Vietnam during the early stages of the Cold War, this led the entire system on the verge of potential collapse because central banks weren't willing to do what they needed to do, and that was to put the economy into a recession, kill demand in order to make sure we could get back in equilibrium between demand and supply. Sounds a bit familiar? That's exactly what we're going through right now to a decent degree. I'm not saying that it's a direct repetition of history, but while history doesn't repeat, it most certainly rhymes here. And the central bank is likely going to repeat the same mistakes that it's done in the past. If the Federal Reserve doesn't make a dramatic move at cooling inflation and bringing back trust into the economy and bringing back equilibrium of supply and demand, we are likely going to see one Goldilocks asset like gold back in the day, back during the 70s, going into the early 80s, having a major parabolic breakout. And again, we're looking at the annualized chart here. This is taking it from really the decade here of 1970 all the way to 1980. If we dive in here into the monthly chart, we can start to see just how much of a tear gold went through here. And all the while it had a 50% correction along the way, it just kept moving higher up after, setting in new highs time and time again until it had a parabolic blow off top here, going into the final decision where the Federal Reserve finally did the hard thing, where Paul Volcker, the Fed chairman, came out with a swift decision to aggressively increase the federal funds rate, the base cost of capital and credit in the economy. Now, again, just to kind of showcase this here, right, and go back through history a little bit, we can see that back here during the 70s, even back here during the early 1960s, we started to see those signs of inflation popping in. We had multiple waves here of inflation and the cost of living, with inflation really only going down to the lows of 2.8 and 5% here year over year, essentially meaning the Federal Reserve for a decade was not able to make the hard decision of continuously and aggressively raising rates and essentially cooling demand in the economy enough to bring us back down to the healthy target of around 2%. That only happened in 1983. The last time it had happened before was in 1972, the first relative low here that we had during this wave of inflation, this decade-long wave of inflation. And you can see here that this is how it tends to play out here. We had it here in the 1930s into the mid-1940s as well, with inflation peaking as high as 19%. So again, we need to understand here, if we're going to be utilizing this period of time here from the 70s, we need to understand how bad things were. How much did the central banks start to print? What were the federal funds rates at the time? And try to understand realistically what it's going to be like for us here. What can we expect going forward, right? So let's go ahead and take a look at what we've got now. We've got inflation here at around 8.5%. This isn't even. Just bear in mind here, with all the pain we've been seeing in the economy, with all the concern around electricity bills, the cost at the pump, as well as food prices, we can see during the first major wave here, we went all the way up to 12.4%. We are only at 8.5% here at the moment. And again, just to kind of overlap here, to really put things in perspective, when we go down, there's a really cool chart here from Econometrics, which is a really cool kind of data science provider on Twitter. You guys should definitely go follow them. They've got some really interesting charts, and this is one that came out back in earlier February of this year that I think really starts to, again, put perspective here towards this talking point. That whether or not we think that the Fed is going to pivot in a couple weeks or a couple months, the Federal Reserve, when things get too difficult, will likely make the easy decision. It's going to support financial markets. It's going to stop the reduction of its balance sheet. It will either keep it neutral, maybe even introduce some new money into the supply of the economy. They will potentially stop raising interest rates, keep them neutral, or grow them at a slower rate, and maybe even temporarily lower them. Either way, we don't know exactly how they're going to play it out. The key point here is that the Fed, whenever it needs to, is going to pivot, okay? Now, again, right now, the Federal Reserve, realistically, on a healthy perspective, cannot pivot. It should not pivot. If its goal is to reduce inflation in the economy, realistically, and to do the hard decision and do it now, then the Fed cannot pivot. The Fed needs to keep raising interest rates. Demand has not cooled. Commodity markets are proving this. And along with that as well, even though the housing market is starting to see some hit, we need to see a further decline in demand in order to give time for supply to catch up. Right? So we are not there yet. Like the Federal Reserve, again, if it is doing the right thing, it would not pivot. But as we know throughout history, the Federal Reserve likes to play on the tightrope. It likes to play both sides. It wants to cool inflation, but at the same time, it wants to ease financial markets. It doesn't want to put us into a steady recession, right? So again, while I don't think a pivot is coming anytime soon here, we need to understand that eventually the Federal Reserve might do that. And if we start to see a pivot, I think we are going to start to see an asset start to come up, a non-correlated asymmetric asset that is going to be able to act as a store of value as people start to realize that history is likely repeating itself. And that could start to manifest more in a second wave of inflation. This could take many months from where we are now to potentially a year. I want you guys to keep that in mind here, that this stuff does not happen overnight. If anything is telling from the 1970s, it's that this is a decade-long journey where commodities are going to start to shine here, or non-correlated assets that can't be printed into oblivion, okay, and are separate from the traditional financial system. Now, that's the key thing here that I want to focus on, the potential idea here that we could start to see an asset trade very similar to gold. And I'm going to make the case here today to talk about how Bitcoin could very well be that asset, especially after going through a steady decline of over 75% so far, and will likely go through a decline, I think, of around 80 to 85% at a bare minimum. I think that's the kind of range of decline we can expect for Bitcoin. But after that, we could have really green pastures here for Bitcoin, starting to charter into that 6-digit territory that many people had talked about from the previous bull market, going towards 100K, 200K, you name it, as people start to lose faith in the base currency, the dollar being the world reserve currency. Now, this has already been a topic of discussion for a long time. About a decade ago, it was a topic of conspiracy theorists, or at least that's what they got called, and now it is a mainstream talking point across economists with the introduction of central bank digital currencies, with the hyperinflation that we're seeing in some economies, and the inflation we are seeing in the United States, the highest we've seen in multiple decades. The dollar, while remaining strong on the world stage right now, could eventually come back into question if the Federal Reserve cannot lead the way in cooling inflation. If the Fed can't do it, we are going to lose faith not only in the dollar, we are going to lose faith in the world's range of fiat currencies in Asia, in Europe, in the UK, in Japan, in Latin America, everywhere. If there's no stability in the dollar, there's going to be a lot of global liquidity that's going to want to go somewhere. And that's exactly what happened with gold back in the 70s. People lost faith when Bretton Woods, the traditional system that had been built for decades to build stable monetary policy and fiat currencies and lead economic growth, had come into question. That's when the system started to fail. So, as I mentioned earlier, let's go ahead and take a look at some of the historical statistics. Back during 1970, all the way towards 1980, we saw a 152% increase, more than a doubling in a matter of a decade here in the base monetary supply. Well, even though we haven't had, I would say, our inflationary period for as long as we had back here during the 1970s, what we have had here is about 3 years where we've had a 42% increase in the base money supply. So to kind of put that in perspective here, very similar from the period here back in 1969 here to 1972, about a 2 to 3 year period here where we essentially saw a very similar increase in expansion and in the money supply. Now, I don't know if we are going to see the money supply increase like we did back throughout the 1970s into 1980. I would bet that we probably aren't going to see that kind of expansion due to the fact that the Federal Reserve has probably learned from history, and the Fed is now looking at already engaging in reducing its balance sheet, which is going to taper the M2 money supply in the economy. But I will say this, the majority of the growth has come in here. A large chunk of that growth has come here within a very short period of time. Even if the Fed were to keep neutral here, if we didn't expand like we did back here during the 1970s, we are still going to probably see if the Federal Reserve cannot actually do the hard thing and start to reduce its balance sheet and spike interest rates, we are still going to see the ramifications and effects of this. We've already started to see them, but I can tell you all, it is likely going to get worse unless the Fed really starts to reduce their balance sheet. So that's question number one. Will the Fed actually do that hard decision? Will it actually start to reduce its balance sheet and go against what it did back in history? Or at a minimum, keep the balance sheet neutral for a prolonged period of time, similar to back in the 90s. This is the ultimate question, though. When it comes to interest rates, while they don't have as big of an effect as quantitative tightening in reducing economic confidence and risk-taking in small interval changes, interest rates, when they start to get up towards exponentially higher levels, start to have a massive weighing effect on economic growth. And when we take a look back at history here, as we can see back during October of 1970, we can see that there are many times where the Federal Reserve had to practically triple or quadruple the base federal funds rate. Time and time again, not truly getting a hold on the supply and demand equilibrium and bringing prices and confidence down back to reasonable levels, going all the way up to 19% on the federal funds rate. Now, let's just go ahead and take a look at where we are right now and where we came from. We've come from a decade of record low interest rates, practically 0%. Mortgage rates were sitting around 2.5% at the bottom. Almost feels like practically free money at that point, hence why property prices went so high. Stock market indices rallied to new all-time highs. Bitcoin was trending up towards $65,000. Dogecoin was taking the headlines, and meme stocks were up to no avail. Now, we are starting to charter interest rates up at their highest pace in decades. And the Federal Reserve is showcasing, at least as of now, not many signs of that cooling down for the short term. And when I say short term, I'm really talking for the next couple months here, right? We think that the Federal Reserve is going to keep charting higher here until there's more pain. And when that pain comes, they may not do the hard thing of continuing forward. They may start to pivot, right? And this is, again, that 10 to 20% scenario we're talking about today, is that potentially the Fed starts to pivot. If it repeats history here, we are likely going to see market participants, smart money, not flowing to the dollar, not flowing to bonds, and not flowing into stocks, but rather flowing into Bitcoin on a discount. They may take a further decline here and price down to 14K and a nice range of consolidation at previous resistance here as an opportunity to go long on Bitcoin and start to acquire Bitcoin here at this discount rate until it drives all the way back up to the highs and continues to set in new all-time highs. This may very well be the catalyst here for Bitcoin to move higher. And I got to be honest with you all, as someone who really likes crypto, who was really good at spotting the early trends, I have to say, guys, like, this is one of the areas I think I excel. You guys know I'll mention when I'm bad at things or I don't know something, right? NFTs, a lot of these new trends that have come to the market. Still a little bit new to me. I understand the basic concepts, but not really seeing the market proposition long term. But I got to tell you guys, back in 2018 and 2019, we were on the ball with DeFi. We knew that that was going to be a really exciting trend. You can go back and watch a lot of those videos where we talked about DeFi. But I got to tell you all, this time around, there aren't many exciting technological innovations in the crypto space that I see manifesting within this bear market. And we've been in the bear market for some time. So if there aren't any major innovations, we got to go back to looking at some of the existing narratives. And one of them is the sheer fact that Bitcoin is this non-correlated asset. There is no government or central bank that owns it. It is widely recognized across the world. There are hundreds of millions of people across the globe who have either utilized Bitcoin, heard about it, or currently hold Bitcoin to some degree, right? And there are still a lot of people who have not purchased Bitcoin, who have not fully understood the potential of it, or have the inability to the way that they invest or where they live to be able to invest in Bitcoin. And that is where a Bitcoin ETF, Bitcoin as this kind of non-correlated asset, could start to come up and really take the center stage. Now again, don't take my drawings as gospel here. They're mainly focused on two key stages here. And I'll go ahead and maybe redraw the second line just to again start to kind of signify the two stages. You've got further capitulation and consolidation, right? So again, another maybe decline here going into 2023. This would also mean that the stock market probably continues pulling back as well. And then eventually we start to set higher lows and higher highs that are indicative here of a further breakout. Again, don't take the drawings as gospel. I'm not saying that here exactly in October of 2024 we're going to be breaking new all-time highs. It's just a matter of trying to get an understanding of how the chart could start to play out. And we could really, from this point on, start to have a euphoric breakaway period into new all-time highs where things really start to get exponential as people start to lose trust in the system. Now again, I'm not saying again that these numbers are finalized here or anything, but just really starting to see the chart break away, people losing trust in the base currency, and probably similar to how gold did in the past, having a blow-off top, people regaining trust in the system, the Fed doing the hard decision, putting the economy through a temporary wave of pain, and things starting to return to normal, inflation getting back to normalized levels, right? That is potentially what could very well happen here. And I think it's not too far out of the cards to expect that the Fed could pivot. It could start to make the wrong decision. It's done that many times in the past. It's been doing it for the last decade, kicking the can down the road. Now, irrespective of what you guys think about that, I definitely recommend you guys check out Rockfin. This is one of the exclusive content platforms I recently joined, and I did an episode on when will the bear market end for crypto and stocks. I think you guys could definitely check that out. That's more of a more kind of moderate expectation of, really how to spot when it's time to go long on assets overall. and it talks a little bit more about the more kind of conservative approach here that, hey, the Federal Reserve does the right decision, essentially puts the economy in recession, we get things down into more discount territory, and things start to smoothen out. So if you guys want to get that perspective and also just learn about the kind of signs to look for when trying to spot when a bear market is over and really when the next bull market is ready, definitely recommend you guys check that out. It's in a similar tune to this video, but focuses again on a couple other different elements. Then definitely consider subscribing to Rockfin. It's only $9.99 a month, and you get access to a ton of other content creators, but you also get access to the premium content here on Rockfin. Now, I know some of you guys are asking the question as well as to whether or not Ethereum would benefit in this environment. And I think that that has to do heavily with how the merge comes out. If the merge works well and Ethereum is able to provide, its merge to proof of stake, and eventually its move towards having not only a reduced monetary policy through proof of stake, but also lower fees through scaling, through sharding, then if that's the case, then Ethereum might give Bitcoin a run for its money. But I have to say, Bitcoin to me, at the end of the day, no matter how Ethereum is upgrading, how much I love Ethereum with DeFi, I have to be honest with you all that during these periods of time, people are really, and again, in this kind of 10 to 20% case scenario, like likelihood of happening, I think people aren't caring about getting yield on their assets or essentially making swaps into other assets. They're looking to find a quick, simple solution to put money somewhere and know that it is likely that in a month, a year, or a decade's time, that by the time they need to sell it, if they needed to realize it or spend it in fiat currency, that they're going to have the same amount of value, if not more. And that's the key point here, that essentially we expect that overall, again, Bitcoin is really going to be the leader here, even though we've started to see altcoin dominance start to charter higher here. Now, again, I would say that it's not a good idea to just be completely exposed to Bitcoin. In fact, it's good to keep an eye on the altcoin market here, because even while that may be the more likely scenario, we need to understand that there are potential other outcomes. And that's why we've been, again, generally exposed to altcoins for the most part over the past few years. We believe that there is a lot more growth potential in risk-on periods, and even in these potential risk-off periods, like we've seen now, altcoins have been holding up really well here. Now, one of the projects out there that has been doing something really exciting in the crypto space that I think, again, is starting to potentially, like many other layer ones, give Ethereum a run for its money is Nervos. And they've been creating a really interesting competitor that's very similar to that of Unstoppable Domains out there on the market, or the Ethereum name system, and that is Bit. Now, for those of you who haven't heard about Bit just yet, I want to go ahead and explain a little bit about Nervos and what Bit offers as well. So for those of you who haven't heard about Nervos, Nervos is an emerging layer 1 blockchain protocol in the crypto space. It uses its novel CKB, or central knowledge base framework, to be able to store and validate information. And along with that as well, it offers the ability through the CKB to offer Web3 domains or identifiers through Bit. Essentially, you can, like Ethereum name service or Unstoppable Domains, have a unique Web3 identifier that you can utilize to receive and send funds. You can also utilize it as a web presence domain. So if people were to type in your specific Bit identifier, they could actually go towards a website that you're hosting. And on top of that as well, you can use it as a login credential for Web3 decentralized applications. Now, what's really exciting about this overall is that it offers the ability to not only streamline the use of Web3 applications and receiving funds, as you don't have to type out some long string address, but it allows you across multiple chains, as it is the first interoperable solution for Web3 identification to receive funds from various different ecosystems. So again, this adds a lot more functionality than that of Unstoppable Domains and ENS, both of which have already gained a lot of market traction. So it's going to be really exciting here to see how Bit potentially grows within the ecosystem, offering an open source, self-sovereign, cross-chain, and decentralized way to identify yourself. Once you own your Bit domain, you essentially have full ownership of receiving funds from that address or from that identifier, and also utilizing it as a web domain for people to be able to search up, again, any kind of web content that you'd want to publish on your Bit domain. So it's a really interesting system. These have started to gain a lot of traction in the market. So if you guys are interested in the Nervos ecosystem and learning more here about what it has to offer, as well as Bit, definitely take a further look into it. Check through the website. They've got over 100,000 bit accounts registered with users from over 178 countries, and they've already integrated it into over 100 different wallet, DeFi applications, and various other solutions within the crypto space, making these bit domains very functionable. So definitely check out the link down below in the description if you guys are interested to learn more. But to close off the conversation here, guys, I want to go ahead and again just emphasize that this video we talked about today, where we were discussing this concept of Bitcoin breaking away, really breaking essentially something that I think we've all noticed by now, which is that Bitcoin is very correlated with equities right now. Similar to what we saw back in March of 2020 when everything was selling off, we are seeing that same correlation playing out now. But with the potential launch of a Bitcoin ETF, we could potentially see Bitcoin really come to the center stage here. And here's the reason why. I want to go ahead and focus here on a really interesting element of the gold chart. We talked about 1970 to here in 1980. But there is a second chart, or a second portion of the chart that we need to focus on, which was here from the early 2000s all the way up to 2011. Now during this time, gold went from around $260 an ounce all the way up towards its highs of around 1912. Now, as you all can probably guess, go ahead, put on our drawings here on the chart. That was a whopping 655% increase in the value of an ounce of gold at the time. You want to know what happened during that period of time? There was a launch of a gold ETF. Now, if we just get a Bitcoin ETF, that alone could possibly be the catalyst to bring us above 100K. Hands down. If we especially enter into, if there still even is the correlation between Bitcoin and assets, and we have to wait for the Fed to make the right decision and really get a control on inflation, and then risk narrative comes back on, then yeah, Bitcoin could still charter up to that range. But if you get an ETF and you get continued inability from the Federal Reserve to maintain reasonable rates of inflation, to get inflation back under control, that's your cocktail recipe for Bitcoin to go to the stratosphere, to really make absorbent highs, the likes of which we probably can't even imagine right now. But you got to have a long-term lens to see that opportunity. What we're focused on right now is not losing track of that potential outcome, and in the meantime, making sure we get solid entries here into this bear market, that we don't rush into it, because we don't know how far things are going to go down before we really start to see that uptick. Right now, it's about preserving capital, taking those discount opportunities when they come to us, those really favorable risk to reward ratio entries, and then focusing on the long term, being patient, and knowing that history is likely doomed to repeat itself. But again, this is just food for thought, guys. I'm curious to hear what you all think about this. Again, it's one of those 10 to 20% scenarios. Who knows? We might get something more conservative. The Fed might do the right thing and continue raising interest rates. That's at least what we're kind of betting on right now, that the Fed is going to go through and do this until we start to see those early stage signs of pivoting. And the more the Fed starts to hint potential pivot in its monetary policy, the more we lean into this 10 to 20% scenario of playing out. But we'll continue to keep track of it here on the channel. And until then, guys, I hope you enjoyed this video. Consider dropping a like. It's a great way to support the channel. And I'll see you all in the next video. Have a great weekend, everyone.